All right, so Richard writes in asking the difference between qualified dividends and ordinary dividends. So let's read his question here. Uh, my Vanguard Consolidated 1099 has 32,000 in ordinary dividends and 27,000 in qualified. As the tax implications of the ordinary dividends to the qualified is a big deal. What determines ordinary versus qualified? More importantly, is there anything I can do to make my dividends qualified? All right, so I have a sneaky suspicion he's getting 32,000 of dividends, of which 27,000 are qualified, and thus 5 are ordinary. He says 32,000 in ordinary and 27,000 in qualified. But if you actually look at the 1099, it says or even your 1040 actually, it'll say total, it'll say ordinary dividends X, qualified dividends Y, if that makes sense. So I bet that's the case. It's hard to get 32,000 of ordinary dividends and only 27,000 of qualified. All right, so let's take a gander here. Generally speaking, we'll dive into this a little bit more in detail. Qualified dividends are just what you get from a stock. You know, I mean, ExxonMobil has a, whatever, $4 a share dividend price. That's the ordinary operations of a stock. And as such, that's called qualified dividends. Its tax is either 0, 15, or 20. And it could be an extra 3.8 when you factor in net investment income tax. But we'll just read directly from Kiplinger's. At some point, almost in every investor's life, they'll be alerted to the fact they're collecting qualified dividends. That inevitably prompts the natural question, what are they? Ultimately, the importance of this distinction is to do with how you're taxed on your dividends. The tax, well, we're going to talk about that, all right? So, but a more fundamental level, what exactly is a qualified dividend, and how do you know if the dividends paid by the stocks in your portfolio are qualified? And what dividends are ordinary? All right. The concept of qualified dividends began in 2003. Was that the Tax Cut Act or the Pension Protection Act? I can't remember, but that's George W. Bush. The lower qualified rate was designed to fix one of the great unintended consequences of the U.S. tax code. By taxing dividends as a higher rate, the IRS was incentivizing companies not to pay them. Instead, incentivize them to do stock buybacks, which are untaxed, or to simply do tax, simply order the cash. And don't forget, my friends, not only was it incentivizing them not to pay them, but we still have the double taxation of dividends, even if they're taxed as qualified dividends. And on top of that, you know what's not taxed? In fact, it's not only not taxed, but you get a write-off as a business operation, borrowing money. So if you borrow money, you get to write that off, that interest payment off on your balance, your income statement. So there's every incentive for you not to pay dividend incomes, because dividends are taxed. They're taxed to the company as part of the profit they receive. They got to pay income tax on that, and then it's taxed to you, the shareholder. Right? Whereas when you borrow money, it's not taxed. You actually get a tax deduction in terms of your write-off on your income statement for the loan interest. Isn't that crazy? Yeah, it's nuts, right? So anyway, that's one of the negatives about dividends, the double taxation, and that leads companies to be more inclined to take on debt, which is not good. Let's see. By creating the lower qualified dividend tax rate that was equal to the long-term capital gain rate, the tax code instead incentivized companies to reward their long-term shareholders with higher dividends. It also incentivized investors to hold their stocks longer to collect them. Yeah, maybe. Don't forget those stock buybacks, while tax-free, they do give a bump. I mean, all they're doing is they're reducing the amount of inventory for the stocks, the amount of supply. You reduce supply, what does that do? It makes the price go up, assuming demand doesn't drop off as well. But if demand's flat and supply goes down, that makes the price go up, which is kind of the deal. And on top of that, it's a tax-free event. But it's not really tax-free, because they had to pay income tax in which to get the cash to buy the stocks back, if that makes sense, on the profits. So if they made profitable, from a cash flow perspective, they made profits, they still had to pay taxes on the profits in which to use that money to buy back those shares. So it's not tax-free. It's kind of frustrating, actually. All right, it's debatable whether a lower tax had the desired effect. In the 17 years that have passed, companies, particularly in the tech sector, continue to hoard a lot of cash. Yeah, well, that makes sense to me. I mean, they're saying, look, we're going to either buy back our shares because we think the price is way low, or we're going to use it to invest in, Google invest in YouTube, where I'm right here. Hasn't been profitable for Google yet, though. All right, so to be qualified, a dividend must be paid by a U.S. or foreign company that trades in the U.S. or has a tax treaty with the U.S. The next requirement gets tricky. You must hold the shares for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. If that makes your head spin, just think of it like this. If you held the stock for a few months, you're likely getting the qualified rate. Yeah, exactly. So you don't want to be bouncing back and forth. All right. Ordinary dividends. Certain types of stocks don't make the list. Real estate investment trust. I do remember that. And master limited partnerships, MLP. I don't know if MLPs are still all the rage, but a few years ago, MLPs were all the rage. Master limited partnerships and real estate investment trusts do not qualify as qualified dividends. They have more complicated tax rules. However, in some cases, they might actually have a lower effective tax rate. Interesting. So, money market funds and other bond-like investments don't pay ordinary dividends. Well, they're bond-like investments. Money market funds and other bond-like instruments generally pay ordinary dividends. I call that ordinary income. I guess that's what they're saying. I don't know. Bond-like funds. Not preferred stock. I'm not sure what they're saying there. Money market pays interest. Bond funds pay interest, which is taxed as ordinary income. So I'm not sure what they mean there. The good news is actually not your problem to figure all this out. Exactly. The firm will figure that out. But knowing whether you're being paid qualified dividends can help you plan properly. Perhaps you can arrange your dividend stock portfolio such that the lower tax qualified dividends are paid into your taxable brokerage account. Exactly. And higher tax ordinary dividends are paid in your IRA. So that's why I say put your real estate investment trust in your Roth. Absolutely, because they're taxed not as effectively or not as efficiently, I should say, as your as qualified dividends. Most normal company stocks you've held for at least 2 months will have their dividends qualified. Many unorthodox stocks, such as real estate investment trusts and master limited partnerships, will be taxed as not. It won't be taxed as ordinary dividend. All right. Hope this helps. That's a pretty good article by Kiplinger's. I'm a big fan. So anyway, so for my man Richard here, he'd definitely want to put his REITs in a Roth IRA or a traditional IRA, because remember, anything that comes out of a traditional IRA is taxed as ordinary income anyway. But you don't want your REITs necessarily in a taxable account, because you're going to get ordinary dividends as opposed to qualified. But if you have Exxon stock, I just use that for example because I own it. You should not own it. I own it. So if you want to go bankrupt, own what I own. But that would be a good thing to put in your brokerage account because it pays qualified dividends. Hope this helps. Thanks for the question.